The Fed finally cut rates. To little surprise, good news for stocks, but the market's reaction is cause for concern. Of course, we're talking about the interest rate decision. The Federal Reserve cut rates by a quarter point. It's now anticipated 87% chance the Fed will cut again in October. In fact, many believe this is the beginning of several interest rate cuts this year. Well, the stock market like this, especially the Russell, the small cap index, surging to all-time highs. Top left-hand corner, volatility index, falling as all equity indices and cryptocurrencies rose. This is definitely a risk-on environment. Now, the real message comes from the bond market, and this is really interesting. Top left-hand side, 13-week Treasury. That's the shortest term maturity. That's down. We were just at 393 the other day, now to 387 following the Fed cut. During the same period of time, the longer-term maturities, the 5, 10, especially the 30-year, are rising. So the short-term yields are falling. Long-term yields are rising. And this is the basis of our conversation today, yield steepening. We're going to take a look at the difference between the 30-year long-term maturity and 13-week short-term. 13-week in yellow, 30-year in blue. Notice what's happening following the Fed cuts. The long-term maturities are rising. Short-term yields are falling. They're spreading out between the two. In fact, speaking of spreads, take a look at the difference between the 30-year and 13-week. That's now almost at 1%. That's a significant level. I'm going to tell you why. Take a look at the 2008 crisis, the financial crisis. Well, at the very beginning of 2008, we saw this 30-year, 13-week spread widen and break above 1%. This signaled the beginning of the crisis. What happened here? Well, in yellow, that's a 13-week. In blue, 30-year. The 13-week plummeted. The yields went down a lot because short-term maturities, especially something like the 13-week, are very sensitive to the anticipation of Federal Reserve decisions. Long-term maturities like the 30-year, they move in anticipation of long-term growth and or inflation. Well, the widening of the two showed us the Federal Reserve's cutting rates, and those rates over the long term could lead to inflation or growth. Now, there's two cases. Number one, a bullish steepening. This is a good thing. This occurs when equities rally and there's a risk appetite for everything, really, small cap stocks like today. It's great for the banks also because of their net interest margin. What is that? That's the difference between what the banks pay in interest and what they charge for loans. So longer term maturities, that's very representative of mortgages and loans that they issue. Short term maturities, that's like a savings account. The wider the difference between the two, the greater the bank's net interest margin, profit margin. Now, take a look at 2008 financial crisis. In fact, following the crisis, take a look to see what happened. Again, the bad news is already baked into the cake, so to speak. Coming out of the crisis, late 08, early 09, the short-term maturity, the bottom in yellow, stayed very close to zero. The Federal Reserve kept rates at zero for a long time. The longer-term maturities in white, they began to rise as a result of low interest rates and a lot of quantitative easing. The anticipation of growth and inflation resumed, and those longer-term maturity yields began to rise. This is a bullish steepening. Now, there's also a bearish steepening. This is bad. Short-term yields decline because many believe the Federal Reserve just is too late. They cut rates too late. There's already a crisis afoot. Long-term bond yields rise, but not because of growth, because of inflation. See, the Federal Reserve's cutting interest rates, just like the other day, because of those awful job numbers. But the low interest rates, well, we're now anticipating more inflation as a result. More inflation without the economic growth, without GDP or, jobs numbers improving. Stock trends, choppy at best. A lot of traders, investors, they don't do well in this type of environment. Defensive positions, they do thrive, like healthcare and utilities, energy, but the growth names, the technology, the cyclical names, they decline. So take a look at a bear steepening. This is following the tech bubble of 2000. In yellow, short-term maturity, plummeting. White, long-term, 30-year. That was rising. The Federal Reserve was too late in cutting rates, But when they eventually did cut rates, that fueled future inflation, but that did not save us from the recession. So, how do we know what we're at the beginning of, possibly? Well, as a rule of thumb, a yield steepening after a crisis, that's usually bullish, signaling a new growth cycle. That's when the Federal Reserve cuts rates, and then we start to see long-term maturities rise. A steepening before a crisis, that's usually bearish. That means the Fed is behind the curve. They're cutting rates too late. They're cutting rates, but the economy is already declining. Well, what does this mean for stocks? That's what we all really want to know. Well, in a growth steepening, that's a good case scenario. The banks, like the net interest margin, they thrive. Cyclicals, technology, small cap, like the Russell today, they do very well. In an inflation steepening, we see defensive positions like healthcare and energy and utilities. They do well, while the cyclicals and the technology really fall to the wayside. How do we know what's coming for us soon? Perhaps. Well, let's take a look at the bond market, like Yahoo Finance. We take a look at the 13-week bond. It's a 388 yield, and the 30-year at a 472. Again, we're nearly at a 1% spread between the two. So we're going to watch a couple things. First of all, the spread. We want to see if this widens. If it does widen, we really should be aware of what exactly is going on. Is the long-term yield, the long-term maturity, like the 30-year, is that rising and leaving the short-term, very low? But we also want to watch the stock market. When this yield curve widens, what does well? Defensive positions like healthcare and utilities, or cyclical names like technology and AI? I think that will really be the key. The market's going to send us a signal through the stock prices. Now, we've written about this extensively in our Just the Data Substack newsletter. We'll provide a link in the description of this video. And we detail this phenomenon and what we can look for specifically to guess really what's going to happen next. We hope this has been helpful. We look forward to seeing you back soon.